All right, I see a few more folks jumping into the virtual room. We're going to go ahead and get started here today. Welcome to Arrive's Q1 2024 Financial Performance Webinar. Our speakers for today are Ryan Frazier, our CEO and co-founder, Cameron Wu, our VP of Investments, Jake P., our Head of Operations, and myself, Korin Hedlund. I lead our Investor Relations team here at Arrive. A quick disclosure and a good reminder for all, this is not a research report or investment advice. All opinions expressed in the webinar are those of our presenters, and past performance is not indicative of future results. A brief agenda. Cameron will walk through Q1 2024 highlights, specifics around leasing for both single-family residential and performance of vacation rentals. Jake will then jump into dividends and share prices, and then Ryan will take it away with our roadmap and share a little bit about what we have also released. And then we will jump into Q&A. For folks that are just joining and this is your first ever webinar, we take questions all in chat. We'll either answer them there, do a little bit of a combo, and answer them live after prepared remarks. So we typically go 20-ish minutes for prepared remarks, and then we move forward into Q&A. All right, I'm going to welcome Cameron up to the stage, and I will see you all in the Q&A session.
All right. Thanks, Korin, and welcome, everybody. Appreciate your attendance today and engagement. So just to go over some of the high-level operating metrics in both our individual property portfolios as well as the SFR fund and then some vacation rentals. Then I'll turn it over to Jake. So Arrive is the largest platform for investing in fractional residential and vacation rental properties. So to date, we have offered 358 individual properties, 33 within the SFR fund, and that represents 62 markets over 20 states and $152 million of property value funded. So a lot of great milestones there. We've been operating for a little bit over 3 years, so appreciate everybody's investments over the years. Here is just a quick map representing where our properties are located. So you'll see that we have a heavier concentration in the Southeast with some dispersion in some select Southwest markets, and then a couple of properties sprinkled in the Northeast that are representative of our vacation rentals. So it really represents kind of the thesis of where we are investing, which tends to be newer construction homes in areas where you can still get a pretty nice house for under $300,000, and then areas that have positive net migration, which means more people coming in than leaving, and a pretty good quality of life. So that has landed us largely in the Southeast, and you'll see that a lot of our higher conviction areas are in the Tennessee area, Arkansas, and Georgia markets. For individual single-family residential leasing, we achieved a 92% stabilized occupancy during Q1 with 54 signed leases, with it being split between first-time leases as well as releases of existing properties. And we have a 21-month average lease term, and 72% of those leases were above forecast. On single-family residential fund leasing, we ended the quarter at 95% stabilized occupancy. 17 leases were signed in Q1, 17 homes were added in Q1, and 74% of those leases were signed at a premium. So even though a smaller sample size, pretty stabilized statistics there as far as how many properties we got above the expected pro forma rent. And we expect to maintain this stabilized occupancy percentage even as the portfolio is growing within the SFR fund. It only takes, tens of properties to start getting to a stabilized level where you're able to maintain operating performance. Next, on vacation rentals, in Q1, we had $705,000 of gross booking revenue across all 38 properties. To date, we've received 820 total ratings. And I'd just like to call out Arrive's internal property management, which there are about 12 properties, and we've been operating that since about October of 2023. So a little over 6 months in operations with only a handful of properties. And I'd like to call out that we've gotten nearly 200 reviews already with a 4.94 average rating for our internal property management. So really a nice testament to the internal operations going on here and managing the vacation rentals, as well as that really high review rate. right? When people are enthusiastic about the 5-star reviews, they tend to come in more frequently. And we're intentionally employing a lot of strategies to make sure that we are getting those reviews, because social proof is such an important part of vacation rentals. Much like having a restaurant, you got to have Yelp reviews and Google reviews for people to kind of make the leap and try out the restaurant. Same with the vacation rental. So it's been a very intentional part of our strategy. And the team's done a really great job of accumulating a lot of reviews in a very short period of time, and the overwhelming majority being 5 stars with that 4.9 average rating. So we've had 38 bookable vacation rentals by the end of Q1 across 21 vacation rental markets. And then a nice little guest testament there on one of our properties in Arizona in the Phoenix market called the Cardinal, which is right by the stadium where the Arizona Cardinals play, hence the name. And it's kind of famous for getting a really large booking when the Super Bowl was there. I think it was on the order of $25,000 for a 2-night stay during Super Bowl weekend. Okay, so real quickly, just going over some of our investment product focal points with the single family residential properties and really the asset class in general, having to do with long-term rentals. We're really focused on leasing right now, because in the rental industry, there's really 2 seasons. There's a down season, and then there's a pretty hot season, of which we are right in the middle of right now. So we're really focused on making sure that our leasing is as strong as possible. And we're working with our property managers very closely on that process. I would say with leasing, we've injected ourselves into the property management scheme very intensely. We more or less control pricing, as well as a lot of the leasing policies. And just to kind of reiterate what our strategy is, we opt for longer term tenants. So by default, our lease is a 2-year lease. And that can oscillate between 18 to 24 months, because one of the other key levers within our strategy is controlling lease expirations. So you'll find that most of our leases end between February through June. And this is very intentional, because we want to capitalize on the hot leasing season. So if we did have a household that was going to move out, we at least want to get it back when we can have the best chance at leasing it quickly and leasing it for top dollar. There can be a pretty big variation in operating results, whether you are attempting to lease it in the high season or the low season. So during the hot season, you could lease properties as quickly as 2 to 4 weeks. And in some cases, you can pre-lease them. So that's one program we're turning on with our managers is pre-marketing. So right before the tenant moves out, we get the property on all of the rental aggregators, so Zillow, Redfin, et cetera. And then we market it before it's ready and start accruing that interest. So all of those are strategies to reduce the vacancy time and increase the chance that it leases at a great rate without dropping the rents pretty quickly. During the slow season, leasing can take up to 90 days, 120 days, and there can be an 8 to 10% difference in the rental price. So that's why we like to have expirations occur where we have them lined up, and thus the 18 to 24 month lease range. Within the single family residential fund, the assets are the same as single family residential individual properties. They're just a cross section of well-diversified markets and price points that we have strong conviction in. But we're focused on the same things. With leasing season, we're really just trying to capitalize on that. And with the fund being still fairly new, where we launched it at the end of November of the past year, we're still in very much the growing phase, stabilization. So we're trying to get those properties leased up as quickly as possible, and are focused on the same things. And then with vacation rentals, we've been really consolidating all management to select partners and internal management. So recently, we parted with one of our other property managers that had managed a couple properties, bringing them in-house, and expect to have better results going forward. Also, I know it's been a hot minute since we've had a couple of vacation rentals on the platform, but we do have one that is in the Phoenix market. It is music themed. It's called the Beatbox. You'll see a picture of it there, really well designed. And we should be having that available for investment fairly soon. We've got another vacation rental under contract. And then we're also working on our Stranger Things house called the Buyer's House, which is looking to be on track for a summer launch. So we're really excited about that. So those are some of the operating results from the portfolio over the past couple months. And I'm going to turn it over to Jake now to go more in depth into dividend and share price analysis.
Perfect. Thank you, Cameron. So we're going to talk a bit about how all of that operational performance actually translates into returns for investors. And as a recap, real estate investors earn returns two different ways. There is the dividends, which is the cash flow that's generated from the rental activity at each property. And there's the appreciation, which is the change in value of the underlying investment. And those dividends are considered realized gains because we've actually gone and paid out that cash into your Arrived account where you can reinvest those dividends or withdraw them to your bank account. The appreciation is considered unrealized because we haven't actually sold the property yet and distributed the funds out to investors. The value of the shares that investors own may be higher or lower than the initial investment value, but ultimately it's an estimate for right now, and the actual appreciation will become realized when we eventually go ahead and sell the property and distribute the cash to investors. So we'll talk through dividends a little bit about first. The big update this quarter is that we finally started paying out monthly dividends. Rather than pay investors the rental income every 3 months, we've sped up the process to make smaller but more frequent payments to investors that really mirrors the timing of the cash flow that each property is generating. Over the 3 monthly dividends that happened in Q1, we paid out over $1 million, which brings us to $5.6 million paid out all time. Dividends are really a big benefit of investing in real estate because you lock in some investment returns now, even while still looking for that long-term appreciation. This is a snapshot of the current annualized dividend rate for the 276 different properties that each paid 3 monthly dividends in Q1. It's basically taking their first quarter payment and extrapolating it out for a full year to give an annualized look at the dividend yield. There's a lot of confounding variables on this chart. It includes single family residential properties, vacation rentals, properties with different amounts of leverage and in different markets, etc. And again, it's only using the last 3 payments for each property rather than all of their past dividends to date. But we can see a couple of interesting things here because this chart is really reflective of the point in time in which we bought different properties. So first we'll talk through this cohort, which is our oldest properties, which you can see are paying among the highest dividend yields right now. These are properties that were purchased with 60 to 70% mortgage loans at interest rates near 4% and were located in high cash flow areas like Arkansas and South Carolina. Many of these properties are also on at least their second lease, meaning we've been able to increase the rents and therefore the cash flow since they initially IPO'd to investors. Then there's this group of properties that was purchased about 15 to 24 months ago. During this time period, the housing market was booming, and we started to buy properties in more appreciation-focused areas like Nashville, Phoenix, and Denver that traditionally don't cash flow as well. This set of properties was purchased in 2022, right as mortgage rates flew from about 3% in the spring to 8% in the fall. And so these properties were still acquired using mortgages, but at higher interest rates. And as a result, they have lower dividends right now because of that higher interest expense. Most of these will be coming up for lease renewal later this year, which will give us an opportunity to increase the rents to the new market rate. And then as we started to see the market shifting, we adjusted our acquisition strategy a little bit more than a year ago. We stopped using leverage on acquisitions completely, with interest rates still being over 6.5%. And we shifted our focus away from higher appreciation potential markets to cheaper areas that offer more cash flow now. As a result, the properties that we've acquired over the last year are largely paying dividends in the 4 to 5% range right out of the gate. And these properties are all labeled with a strategic refinance candidate tag on their property pages, which means that we hope to add a mortgage to these properties if rates come down enough for it to make sense. Now, they're not included on this graph, but we do have some properties that didn't pay a dividend at all this quarter. These can be properties that are currently experiencing an issue or properties that are cash flowing, where we're saving the cash flow into the reserves for that property for a future rainy day before we resume making dividend payments. And so we'll shift gears a bit into the appreciation side of the return equation. We estimate the unrealized appreciation for each property with a share price for each investment. The share price is a combination of the current estimated property value and all of the assets and liabilities of the LLC's balance sheet. We combine those and we can kind of estimate what the total value of investor equity is for each property. The revaluation starts 6 months after IPO for single-family residential properties and after 12 months for vacation rentals. In this quarter, we have updated valuations for 285 different properties. Of those, there's 254 that have an updated value from last quarter. And about a third of them saw an increased share price, and about 2/3 of them saw a decrease, with the average share price declining 1.6%. This quarter was also the first time in which the single-family residential fund has an updated value. Its new share price is $9.97, down 0.3% from its initial $10 per share price. The single-family residential fund is a bit different from the individual properties since it's continually available for investment and it's constantly adding new properties. Investors will actually buy shares at this $9.97 share price until the end of Q2 when we go ahead and do another valuation. Now we're going to combine the dividends and the unrealized appreciation to look at the total gross returns across all properties. Importantly, this chart is not annualized. So older properties here have had more dividend payments and they've had more time to appreciate. But similarly, we'll take a look across a couple of different groups of properties on this chart. The first is our newest properties that are kind of 0 to 6 months old. And you can see here that they're all around 1 or 2% on this chart, largely because they haven't had any share price revaluation yet. So there is no kind of unrealized appreciation markup. And they've only made a couple of monthly dividend payments. We can also see that our oldest properties, again, have among the highest total returns since they were purchased while interest rates were low. They're all leveraged, and they've made a ton of different dividend payments to investors. And then there's the middle of this chart where we can kind of see that the market's been fairly flat over the last 18 to 24 months, with some properties showing positive gains and others being slightly negative. When interest rates flew up in 2022, people expected to see home prices completely crash, but we didn't see that at all in 2023. When rates increased, it reduced demand, but it also reduced supply because homeowners with 3 or 4% mortgages didn't want to sell their houses. The result is that the market's been flat, with some areas of the country seeing small gains and others seeing modest declines, though we are starting to see signs of the market heating back up overall. And overall, we're aiming to hold properties for at least 5 years, which gives us enough time to kind of ride the ups and downs of the market. And that's going to conclude the financial component of our presentation. And I'm going to pass it off to Ryan to talk about what else is new and what's coming up at Arrived.
Hey, Jake. Yeah, thanks for walking through the updates on Q1 performance. And now we'll take a little bit of a look at the Arrive product experience and what's new here over the last few months, and then what investors have to look forward to in the months ahead. So to start, we launched a new updated view of our portfolio and starting to add in more metrics for your Arrive portfolio overall, but also for each of your individual properties or investments into funds. You'll note that we've added your arrived cash balance to the portfolio as well. This was previously on a separate tab, just making it easier to see how much cash do you currently have available to invest in new offerings or withdraw out of Arrived. We've also added a new net return feature, which you can click on to get more information around the total net returns across all of your investments in your portfolio. The next thing that we launched is a full history for vacation rental properties. Last time we shared an update, we rolled out the full property history for single-family residential properties, and now we've expanded that to the history on vacation rentals, and investors can view the full history for any of the properties that they're invested in, or go and browse the history for other properties as well. And then next, a quick roadmap on what's coming soon here. First of all, excited to say that we have new individual properties close to being ready to invest in. They're coming available on Thursday. We hope that this means many more individual properties coming very soon. If you've been following the timeline for our individual properties, you know that we've had some delays in the typical process that each property goes through with the SEC. But good news is that we're starting to catch up. We're making those first properties available this week. We are adding a max investment to those properties just because we know investors have been waiting very patiently for new properties to invest in. But the good news is that we have dozens of more properties coming in the pipeline in the weeks ahead. So there should be plenty of properties for folks to invest in if you are wanting to invest in individual properties versus our funds. The next update is just that we have the Arrive Private Credit Fund coming very soon as well. Everything is ready to go here. We have our first real estate-backed debt investments all ready to go here. We're waiting on final SEC qualification for this fund as well. We'll have more information in a webinar dedicated to the Arrive Private Credit Fund coming as soon as we have a launch date to share. But to give a quick look at this, this will be a yield-focused fund, and it will focus on investing in professional real estate loans. So those would be things like new home construction or new home renovations funded by professional real estate developers and give investors access to the credit side of real estate. We also have been launching expanded account security. So we've launched multi-factor authentication, and we have made that mandatory now for investors to access their accounts. This is as really Arrived has grown, our investor base has grown, and the assets that individuals are investing in Arrived have grown. We want to make sure that we're increasing the security in proportion to that. We're working on some more convenient options, including Face ID. So if you are logging in on a mobile device, that should add some convenience there, as well as some other things to allow investors to remember their device so that you aren't having to multi-factor authenticate into Arrive each and every time. If you've been investing in the single family residential fund, or if you're looking forward to our forthcoming fund, we have liquidity for funds coming up on the horizon. Once you make an investment into the single family fund, after the first 6 months, then those investments are available to be redeemed or sold on a quarterly basis during a redemption window. Since we launched the fund at the end of last year, we have our first, the start of our first redemption windows coming up, and the first opportunity for any investors that do want to redeem or access their capital that they've invested can do so then, and then can do so on a quarterly basis going forward. The same exact liquidity program will be in place for the Arrive Private Credit Fund. And we're also continuing to work on and prioritize liquidity options for our individual properties as well. And then the last is that we have more reporting improvements coming to your portfolio. So you've probably seen that we've been making a lot of changes there to make it easier to understand what you own, how your investments have performed, and how they might perform in the future. So more coming to portfolios over the next few months as well. So with that, that's a quick look at what we've launched recently within the product and what we have coming soon. And I'll take just a quick pause and say thank you everyone for joining us today. Excited to jump into more of the Q&A and answer your questions live. So I'll welcome a few folks back onto the virtual stage with me, and we'll start taking your questions. So give us a moment here just while we get caught up on the Q&A thread, and then we'll jump in.
Wonderful. Well, Ryan, Cameron, and Jake, thank you so much for prepared remarks. Absolutely fantastic. Can't say enough good things about the engaged crew we have in chat and all the investors joining from all over the country today. So thank you for your time. Jake is going to hop off, and he will be in the chat, either answering some of your questions or teeing them up for Q&A. So if you don't see a response there, know that they are being teed up behind the scenes for us to answer live. So Ryan and Cameron, we have a few to get started with. Maybe this one will be a little bit of a combo question in here. I saw two, John B. and Federico. They said, any comments on the WSJ report? For context, this was Democrats in the U.S. Senate and House of Representatives have sponsored legislation dubbed the End Hedge Fund Control of American Homes Act, which would force large companies and owners of SFR properties to sell their swath of homes to family buyers. Separately, a Republican-backed bill in the Ohio State Legislature aims to drive out institutional owners through heavy taxation. Is Arrive monitoring the situation, and should investors worry? Ryan, maybe I'll kick this one to you first.
Great. And yeah, I saw a few other questions in the chat around this as well. And yeah, happy to address this. So it is something that we've been monitoring closely. It's also not something that's completely new. I know that there was the Wall Street Journal article this week, but it's been something that's been talked about for the last few years. and some concerns on very large institutions investing in residential homes. It's a bit early to know what the impact on anyone might be of any changes because it's still very preliminary, but maybe we'll talk a bit about what's currently being proposed. So the kind of summary of the proposal is that for any owners who own individual owners who own more than 50 properties, primarily there would be a tax that would be levied and would increase over several years, really encouraging them to hopefully sell some of their portfolio back into the market to lower their tax on the remainder of their portfolio. In terms of Arrived and whether we might be impacted if something like that proposal were to come into law, a few things. One is that our individual properties are individual taxpayers. And so each property is one-to-one individually owned. And so wouldn't really be impacted by how this law is designed. On average, we have one property owned by one LLC, one taxpayer, but then collectively owned by an average of 300 to 500 investors. And then our SFR fund today is accumulating, more and more properties to allow investors to diversify. If it did pass, then the SFR fund might receive tax or additional tax if it exceeds 50 properties. So something that we're monitoring and would be mindful of. And then our other investment products currently outside of equity and residential homes wouldn't be impacted. In general, again, it's something that we'll monitor closely. I think, I would say that if anyone has a perspective or strong opinion on these proposals, we recommend getting involved, reaching out to your local legislators. We really feel like Arrived has a really positive place to play here. And I think there was actually a Wired article on a similar topic mentioning Arrived and the fact that today we have around 400 rental properties that we've acquired and operated. But instead of a few hundred people owning those properties, we have almost 40,000 people collectively, getting property equity exposed to those 400 properties. And with 80 million single family homes in the market, that is a relatively small impact for 40,000 people to, build ownership and equity within residential properties. So we think that, the Arrived model still has plenty of opportunity to continue to grow and serve more and more people without having an impact on the owner-occupied residential market.
Yeah, a couple of points to add there just on the general dynamics of who owns real estate within the US and what are their kind of incentives. So about 3% of the total rental house stock in the US is owned by what would be called institutions, these larger financial organizations that have, for lack of a better term, Wall Street funding. And 3%, that's a fairly small number. And it's only been, in the last 15 years, I would say, since the Great Recession, that ownership has come to be. What I think it provides is a floor on the market and not a ceiling, in the sense that it helps support home prices, it helps support markets, and it prevents neighborhoods really from going into disarray. That's what we saw during the Great Financial Crisis. Is like, from an optics perspective, it can look concerning when you see X, Y, and Z, Blackstone, BlackRock, whoever coming in and buying up homes in a neighborhood. But if we think back to 2010, 2011, those neighborhoods were in pretty bad shape. There were a lot of abandoned homes, foreclosed homes, and just, that becomes breeding ground for crime in general, makes neighborhoods less safe. So the injection of capital from these institutions was actually kind of a saving force in helping accelerate the home recovery for the U.S. So I do think that, there's always kind of an incentive to play the political game, write headlines that make sense. Our pretty strong belief is that institutional ownership is a stabilizing force, but it's also a small force. Ultimately, a home buyer is the organization or the entity with the most purchasing power, because they're not purchasing for investment, they're purchasing for consumption. And there's also kind of a lot of subsidy bills from the government through forms of lending, Fannie Mae, Ginnie Mae, that help people acquire homes. So there's a lot of programs to assist the individual home buyer. And I can tell you that back in the pandemic era, when interest rates were cheap, our biggest competition was a home buyer, and most of the time we lost because they're always willing to pay more and to get the house that they want. Investors make very economically rational choices, which is why I think it's kind of an optimization function to have an investor group in the market to help support prices and keep stability going. So, I view it less as competition one against the other and more as just the composition of the housing market. So, to Ryan's points, it is early to say what will happen, but I wanted to paint the picture of the force that investors play in the market. And often it is demonized, but from my perspective, it's a stabilizing force.
Fantastic, Ryan and Cameron. Thank you for the extensive responses here. Obviously, we know lots of updates are coming daily, if not by the minute, that Arrived is definitely paying attention to and continuing to iterate on. I'll say too, our VP of Legal, John, has curated a template. If you're interested in reaching out to your local representatives, feel free to ping support@arrive.com. We'd be more than happy to send that your way to utilize on your side. Also mentioned too, I'm seeing quite a few questions that are more focused for our 101 webinar, details around specific liquidity mentions or fees. We have tons of resources, and Jake let us know what the schedule looks like for that one. So for today, we'll be hyper-focused on performance of the portfolio, but happy to field those if we have time as well. All right, moving back over, Rena had a great question in here, and I know they've reviewed the resources as well, but it's always good to double down on this live. So Cameron, I'll ping this over to you. I'm an investor in the SFR fund since November 2023. Thanks for placing your trust in us. And the only earnings are $6 and change for the last 2 months, even though securing many more leases. Why is the dividend not increasing? Also, when will the semi-annual annual report come out for the fund? Thanks for explaining.
Yeah, great question, Rena. So I think a lot of your observations are correct in that, hey, in a startup phase of a fund, as properties are increasing, how are we generating the cash flow? And it does take a couple of months, I think, for properties to really start getting into a groove where they get leased up and they start generating that income. So our fund launched at the end of November, and we launched with 8 properties. So as we've been accruing more, they have been getting leased up, and we did launch into what is traditionally a down season, right? So December was a slow leasing season. January, we start getting people coming out as winter starts thawing a little bit. And then now we're really in the thick of leasing season. So we do expect a lot of the leasing activity to pick up, generating income more quickly. To date, the fund has paid out an annualized dividend of 4%. So I don't know exactly how much you have invested, so I can't index that $6 to the amount, but it has been a 4% annualized dividend. So that's kind of the explanation, I think, behind the numbers you're seeing is, you take that 4%. And then also, we used to pay dividends on a quarterly basis, and now we pay them on a monthly basis. So if you were to take 4% annualized and divide that by 12, then that's 0.33% on a monthly basis. So it's going to be a smaller number for each dividend that you receive, but it's on a more frequent basis now. So that may also contribute to kind of the, why a $6 dividend, but it's happening more frequently.
Awesome. Sorry, I got stuck on mute. Apologies for the delay there. I believe their investment was around 2000. So Rena, let us know if there's any additional questions there. It sounds like it's covered in chat. They said thank you. All right, moving back over here. I know we have quite a few great questions in here. One second. One in here from David. Why did the minimum share price increase from 10 to 11 for the single family residential, I believe, fund? Can you expect a minimum to increase over time? I know Jake walked through this briefly in prepared remarks, Cameron, but would you mind doubling down?
So the minimum share number increased from 10 to 11. I believe that there's still a $100 minimum for investment. So to the extent that the share price is $9.97, then that times 10 would be $97. So it rounding up to 11 then would get you over the $100 minimum. And that is one of the differences. You're making a good observation about the difference between a fund and an individual offering. Whereas with individual offerings, we set the price at $10 and then take the total number of dollars needed, divide by 10, and that's how many shares you have. The fund is an open fund structure where the value updates on a quarterly basis. So when that value changes, then the number of shares required could change. And just, if we're living in just to explore the mechanic, if the share price was $20, then that could come down to a 5-share minimum to get to the $100 investment. So really just a function of share price changing with an open fund structure.
Fantastic. Awesome, Cameron. Definitely appreciate it. Scott, I saw you just joined. Welcome. We'll be sure to send out the recording to all folks so you won't miss anything. And then we'll also be sure to upload it to our webinar landing page that Alejandro shared in chat. I believe, obviously, Ryan, you walked through our roadmap, what we have coming down the pipeline. I saw a mention in the chat that William's interested in our overall goals to implement in the next 3 to 5 months. I'm curious what your thoughts on maybe a 30,000-foot view or a few feet.
Great. Yeah, no, I think that really would just reiterate some of the things that we've talked about. We're very excited to be back in a groove on making individual properties available again for investment after a bit of a delay that we ran into at the beginning of the year. So excited for more of that to come. And then we've really been focused on bringing the private credit fund to market for investors, just giving investors the opportunity to invest in real estate-backed credit investments as well, alongside our core equity investments. And then beyond that, it's also really continuing to develop and improve the product experience for investors. We've really heard a lot from investors that they want more access and control to understand the past performance of their investments and really what to expect in the future as well, based on kind of the pace of performance. And so more improvements coming in the next few months as well to our portfolio for investors. So those are a few of the things just in the next few months that I'd be on the lookout for.
Fantastic. Awesome, Ryan. Thanks for walking through it. I've seen also quite a few different points of feedback in the chat. We are building for and by each and every investor or learning investor that we have on our platform. I've seen some product feedback updates, different markets, asset classes. We've had our team actively listening in chat and taking that behind the scenes. So feel free to have it come our way if we don't address directly in Q&A right now. We definitely appreciate it. Moving over to Tony's question, why is there a plan to sell properties? Wouldn't it be advantageous for arrived and single-family home investors to just allow individual shareholders in each property ability to sell to others that would like to replace an existing investor? Ryan, maybe I'll kick this one to you first. And then Cameron, if you want to supplement. I know this brings in kind of a few different components on like disposing of a property and then liquidity as well.
Great. Yeah, maybe I'll talk about just the investment period and thesis for individual properties in general, and then individuals potentially selling their shares, and kind of how we think about those things. So in general, we view real estate as a long-term investment. That's what has worked best within this market over time is buying and investing in real estate equity and holding for the very long term, capturing income in the form of dividends during that process, but really allowing time for the equity to appreciate as well. That combined with the historical trends in rental rates also increasing, it just means growing potential equity values and growing potential income. And so that's really what we encourage investors to think very long term. We have on average a 5 to 7 year investment period in mind for our single family individual homes, and then a 5 to 15 year investment period in mind for our vacation rental properties. We might choose to sell a property sooner in the process, or we might choose to hold them longer, but that's on average what we currently estimate. And then we're sort of always listening to the market to decide, what might be the right time to exit an investment property. And the primary way that we think about that is really what's going to maximize the returns or the annualized return or IRR for investors of that property. That could be selling the property earlier in the process because it's seen very quick appreciation and there's a really strong demand for housing in that market at that given time. Or it could be holding for longer because the property is seeing great cash flow and we have a really strong opinion on the future potential cash flow or the future appreciation for the market, whether that's based on the demand versus supply for housing in that market, the growth in the population of that market, or the strength of employers and the economy in that local market. So those are the things that come into play. And how do we think about when's the right time to exit a property on behalf of investors and hopefully driving the highest potential returns for investors in that specific asset? We also, know that investors may want to exit their investments earlier in the process. And, we've long wanted to make an option for liquidity for individual properties available as well. The ability to buy or sell shares of a property from another investor is something that we've really been prioritizing working on building. It is a regulated industry, and so it's a little bit of a longer process to develop that program. But it's something that we are working on that we hope to make available to investors over time. And we think that, as we grow, it will be the right time to introduce that. We want to make sure that the investor community on Arrived is large enough to be able to provide liquidity for individuals who want to exit, and also that there's enough property shares available for buyers who want to buy into the market. So that's how we think about those things. The mix of what's the target investment period or exit plan for individual properties, and then also how do we think about the potential for liquidity between investors over time.
And one of the North Stars of how we decide when to sell a property is kind of this simple statement. If investors won't increase their return by holding onto it longer, we shouldn't hold onto it for longer. So just kind of the high level answer to your question is there are different investment cycles where there are different parts of the country and different assets that are going to be beneficiaries of different cycles. It could have to do with the economy. It could have to do with population change. It could have to do with politics and just various policies that states implement. So if we are holding onto a property and something changes where we don't believe that investors are going to get the highest return anymore, it makes more sense for us, from our perspective, to sell the property, cash everyone out, redeploy those funds to where the next opportunity is. So, I think that having both options is maximum flexibility because people should be able to exit on their own time. But from a holistic investment perspective, if we want to maximize returns for everybody, then it still does make sense for us to sell properties to capture certain cycles and then redeploy funds and reinvest. And quite honestly, it may not even be in the same asset class. There may be a different opportunity within residential real estate where, as on the whole, we want to have more of Arrived investors' portfolios in those types of assets because it's ultimately reflective of our investment conviction where we choose to deploy capital. So purely from investment returns perspective, that's why we would exit assets rather than solely leave it to investor, getting their own liquidity and holding forever. Don't get me wrong, there may be some properties that we hold for a very long time, and there may be some properties that we sell faster than 5 years.
Fantastic. Awesome. Appreciate you both walking through this. I did see a couple questions on markets. So if you're comfortable taking this one live, I know Willie had asked, will Las Vegas ever be a place you buy properties in, especially vacation rentals? Cameron, I think there was mention of Maryland, Washington, D.C. I saw a few mentions of adding, I think it was Utah and Texas outside of the fund and individual properties. So maybe a holistic understanding of the markets and how we choose.
Yeah, certainly. So just from a high level, markets are going to be probably the most important thing that you base your investment decision on. It's the starting point. And then once you have conviction in that larger macro thesis, then at that point, it becomes more tactical where you're saying, okay, now which home specifically is going to maximize cash flow and appreciate the most, say within a zip code. So that's kind of the two-step process. Specifically about Las Vegas, since you're asking about that, William, and this is a market I have a little bit more insider information on, as I lived there for about 10 years before moving to Seattle, is that, like, yes, we were looking in Las Vegas for quite a bit, because I do believe that that's a market that's going to continue to benefit from, say, population trends, people moving out of California into Nevada, which is a no income tax state. So a lot of people make their wealth in California, kind of live their life, and then they exit to Las Vegas for the warmer weather and just the city amenities. So I think it's a good market to invest in. I think that with any market, you need to catch the right cycle. So our observation of Las Vegas is that right now prices are still a little bit too high. We're trying to find good yields, areas that we had a lot of conviction in, and it just felt that everything was just too expensive. So I wouldn't rule out Las Vegas categorically, but timing wise, it's a challenge. Now, vacation rentals specifically, this one's a bit of a tougher nut to crack. If you think about Las Vegas's economy, it's primarily tourism. So you need people to stay at the hotels, then they're going to eat at the restaurants and go to the clubs. If you stay in a vacation rental, not on the strip or not near hotels, then there's a good chunk of revenue that is being lost. And then, your tax base decreases for the city. So Las Vegas has not been issuing permits for vacation rentals. You do need to be permitted to operate a vacation rental in Clark County. So the buying opportunity is generally not there. Now, you could still invest in Vegas vacation rentals in the larger metropolitan area. So if you go to Henderson or Boulder or some of the outskirt areas, then you can. But then you start losing some of the appeal of having a high cash flowing asset that's close to where all the action is. So that's one of the challenges. So I don't foresee that we'll be able to enter the vacation rental market in Las Vegas proper with legislation as it currently is. That could change. And I still view Vegas as a good long-term prospect for single-family residential and long-term rentals when the timing is right.
Fantastic.
And just a few other things about the other locations that you had mentioned, Washington, D.C. We have exposure to that general area via Virginia. So we've been investing in a couple of different markets in the Virginia area, which some of them are pretty close to Washington, D.C. DC is a very expensive place to live in general, though, so we're not buying in DC proper. But you'll see that this is a common theme amongst a lot of our markets is we may not be in the center of where the action is for the MSA. We choose to be on more of the second and third ring areas of that MSA or an adjacent town that has more growth potential and cheaper entry prices. That's where we believe more of the growth is going to be for the foreseeable future. And then Texas and Utah definitely noted. Those are two markets we've recently entered into the fund, and we'll be also having individual offerings for those markets as well.
And Cameron, apologies if I missed this. Did you touch on Michigan in particular?
I have not touched on Michigan. I think that, Michigan, there's a couple of markets. I've heard actually a lot of really good things about Detroit recently, despite kind of the Great Recession. During the Great Recession, it was kind of a poster child for really distressed real estate. But I've actually heard that a lot of parts of it are recovering well. So Detroit is something that we can, keep our eye on. There's not a lot of huge markets in Michigan, but then also we invest in plenty of college towns as well. So Ann Arbor, I think, could be an attractive place to go. We just haven't made our way out to all of the different markets in the U.S. yet, but Detroit in particular is interesting for a higher income play.
Definitely. I have to throw in an OHIO there, but I understand that that it could be a good investment. So definitely appreciate the feedback. I'm seeing some great feedback also in terms of how we're breaking out dividends. So Alejandro jumped in there, and then Alexa, our VP of product, is also taking a peek, as well as our whole team. So keep it coming our way. In terms of the other markets, I would say that I'm seeing mentioned in chat, Cameron shared great details on how he and the team think about that. I know we have a few more questions to get through before we close our virtual doors here. Cameron, there was one in here about expansion that we're seeing. I believe Son had asked, let's move this in the queue before we move forward. Can you outline which states and cities where Arrive will offer in the next quarter or so? Do you have a vision of what that might look like?
Yep. So in the very beginning, we were pretty expansive on market. We quickly got into a lot of different markets. There were a lot of growth opportunities. Interest rates were sub 4% for a home. So a lot of places had a lot of really good growth potential. As rates have increased, starting in kind of mid 2022, you got to get pickier and pickier with each market because it's harder and harder to grow with the potential when the effective cost of housing is high because of interest rates. So that was a little bit of a precursor to say in the next short to medium term, with rates coming in higher than expected and inflation being more persistent, then we're getting even sharper with our pencils on which markets we really have the strongest conviction in. So there are markets that we've already gotten a lot of exposure to, and we're doubling down in those markets. So those include many of our Tennessee markets, many of our Arkansas markets in Northwest Arkansas and Fayetteville, and then parts of Little Rock. Various towns in North Carolina, we continue to see really good migration patterns of people who are relocating from New York and Boston area and those really large population centers down into a more affordable North Carolina market. So those Southeast markets that have favorable tax regimes, Tennessee is a no income tax state. Most of these places have pretty low property taxes. Your dollar just goes further there. So there's more affordability, and they have enough infrastructure and connectivity to the interstate freeway system that they're primed for growth, right? It's not as if it's 5 or 10,000 size towns that we're investing in that could grow really large. You got to have a couple 100,000 people at least and some interstate freeways to really have growth start coalescing around those areas. So those are the higher conviction plays that we have where there's very favorable macro trends with affordability, and then from there just kind of doubling down on those places.
Fantastic. Awesome. I'm sensing some themes in the chat. We're seeing lots of questions around markets and the research that we're doing on our end. So it'd be curious to know if that information would be helpful for us to showcase in some sort of fashion outside of a webinar. So give us a thumbs up in chat if that would be helpful. We would love to know what you all would like to see on your end. All right, moving back over to the chat here. I think we have a few more questions here. One in here from Lauren. This one's great. I reviewed the recent market analysis from the Bureau of Economic Analysis and National Bureau of Economic Research in February 2024, indicating that the median home prices in the U.S. are sharply contracting at levels never seen since 1964. When factoring yearly % change in median sale prices of houses sold, this appears to indicate that a housing recession is imminent. Cameron, we would love for you to put on your hat here for a little bit of a thesis.
Yeah, and I think that those observations are largely correct, which is also corroborating the answer I just gave about narrowing our market selection, right? We have to be pickier about which areas that we go deeper into. Now, as far as a housing recession goes, recession is, from a technical term, is when you have 2 quarters of negative GDP growth as it relates to a macro economy, right? So as far as housing recession goes, could we see a pullback of prices? Absolutely. And I think that's some of what we're seeing. Now, it's been pretty modest, and it's been localized, but overall, I would say that in the last couple quarters, we might have experienced -1 or 2% depreciation in the U.S. as a whole. But some markets are still growing by 4 or 5% on an annual basis. So it's not that there's going to be, from my perspective, the same phenomenon that happened in 2008, which was really a mortgage crisis. There was too much bad credit in the system. Asset prices went up too fast. There was a high supply of it because home building was just off the charts. From about 1999 to 2005, an insane amount of supply was pulled forward. So you couple that high supply with poor credit, and that was really the ingredients for the Great Recession that happened in 2008. Today is a very different landscape, even though there are some, dents in the armor, so to speak. We have really good credit, mortgage credit within the U.S. right now. A very small percentage of mortgages are delinquent. there's very few mortgages that are underwater, which means that the amount of money owed on the loan is higher than the property value. Very, very, very small percentage of that. So certainly, a recession at large could cause people to lose their jobs, which then in turn, they may have to give up their house. But in this case, if they have to sell their houses and get out of their mortgage, most of them have positive equity, so they're not going to go into a distressed situation. So that's one of the primary reasons why I believe, that positive credit, as well as just also the low amount of supply in the market. It's not as if there's, an oversupply. In fact, there's an undersupply of homes in the market because builders really didn't build anything from 2009 to about 2012, 2013. You know, most builders went out of business during that time as opposed to put up houses. So low supply, good credit quality, that's keeping the markets afloat right now. And despite the increase in mortgage payments that we've seen over the last 2 years, you would have expected a higher or a larger decrease in the home prices, but they're kept afloat because people have staying power in their mortgages, and then there's just low supply. So I think that our perspective is that we have to get tighter on our markets and have a lot of conviction in the areas that we believe will continue to grow. But even we're not anticipating a macro landslide because I don't believe that the elements are there to produce that.
Cameron, I think that leads nicely, excuse me, into William's question. He noted that really our investment thesis, or one of our thesis around buying newer homes, why do we believe that these newly built homes are really poised for better investment outcomes than some of the secondary homes on the market today?
Yeah, we do have a lot of conviction in the new home slice of inventory, primarily because, one, you're getting an asset that is freshly built, and Mother Nature does her thing, and older homes, they'll eventually require some sort of major structural repairs. A lot of the stuff that needs repairing is kind of superficial sometimes, but then there's always problems brewing underneath with foundation, the structure, major mechanical systems, and roofs that really start adding to the effective cost of ownership throughout the life of the investment. So, as I was mentioning earlier in one of our first, actually during the prepared remarks, we're buying new homes for under $300,000 right now. And as you think about the slice of the population that can afford a $300,000 home, there's a lot more of those people than can afford a $500,000 or $600,000 home. So the price point that we've chosen to play with is strategic for a couple of reasons. We think that the cost of ownership will be lower, that there's more people vying for those assets. So ultimately, we believe that those areas are going to experience the most appreciation. So, are we buying distressed properties and then fixing them up? We don't think that that's where the opportunity is right now, because with the supply being so low and then the spread between the new home and the resale property being so slim, it makes more sense for us to just buy more of a newly built turnkey asset, because we're not really having to pay much of a premium for that. And we also believe that the land values there can be acquired cheaper, and then we'll be the beneficiary of more appreciation than the already more expensive areas.
Fantastic. I saw one more come in from Krishna regarding this topic before we move to one other one that's a little bit different. What about poor quality of building materials due to inflation? Cameron, what are your thoughts here?
Well, certainly materials, being commodities, they are going to get more expensive with inflation. As far as the quality of them go, I think that, we're at a nice point where even mass manufactured materials are of pretty decent quality. We may think back to homes built in the 1900s and 1910s, and there's plenty of them here in Seattle, and a lot of them are still standing. So certainly there's a testament to old school quality using, a freshly chopped down tree and real hardwood. And I think that does ring true in a lot of cases. And then you had more mass scale housing start coming online in the 60s and 70s, where it was less artisan built homes and more companies that are starting to import materials in, and that was kind of the beginning of mass manufacturing of those materials. I think some of those homes are pretty perilous to invest in because sheetrock would fall apart, and you didn't have high quality electrical parts and things like that. But from my observations of more recent home builders, a lot of the large home builders that we're buying from, they actually have the most leverage and power to get the best materials because they buy in mass. And these are commodities we're talking about here. So, science gets better, engineering gets better, the material manufacturing process gets better, and they're still able to attain them at a cheaper cost. Whereas an individual with no leverage versus D.R. Horton, who's building thousands of homes per month, they're going to be able to get kind of the optimized point between cost and quality of material, because ultimately they're on the hook for the warranty, right? They have a 10-year structural warranty. So they have to make sure that they're still building properties that won't cost them an arm and a leg 8 years down the road. So, I can appreciate the fact that kind of the sentiment of mass manufacturing may not imply quality from a kind of traditional sense. But from what we've seen, a lot of the big box builders, they do a pretty good job on building the homes and have a lot of buying power and leverage in the materials market.
Fantastic. Awesome. Appreciate y'all walking through it. I think we only have one more question in the queue before we shut our virtual doors. If I missed a burning question that you have, please keep me honest in the chat here. This last one's from William. What plans to be able to compete with other major players such as Invitation Homes, American Homes for Rent, and Progress Residential? Cameron, I know American Homes for Rent is near and dear to you.
Yep. They're my former employer, so I have some good insight into kind of how the larger players operate and how they view their competitive advantages. So I think what they do a really good job of is entering into a market, building scale, and operating more cheaply than you would if you had a third-party manager that you're not in-housing yourself. They are an internalized property management function. Most of those larger players, in fact, all of them are, because the economics make more sense that way. So if you were to own 3,000 homes in Atlanta or Dallas, it makes sense for you to have your own property managers, your own leasing staff, and even some of your own internal maintenance functions like exterior painting, HVAC. It all makes sense to have that in-house. So their effective cost of operating is lower than contracting out. Their other opportunity where they got in was they were buying during the Great Recession. So they were able to have access to a high supply of homes in a dense market. And there was really just a buying opportunity in the early 2010s. So that scale, that operating scale, plus the buying advantage, that was kind of a fleeting moment in history. That's what built up those companies. So I do think they do a really good job of operating, but kind of their strength is also one of their susceptibilities, which is they have a lot of concentration in a smaller number of markets. So they have 60,000 homes. At least American Homes for Rent does, in about 40 markets. So, on average, it's 1,500 homes per market, but more realistically, they've got a couple markets that are 600, 700, 800, and a lot of markets that are above 3,000 and 4,000 properties. So if there were to be a downturn or a correction in those housing markets, they have less flexibility to maneuver because they're already a aircraft carrier, where we have more of a swift boat strategy where, we've opportunistically invested in the properties that we thought were the best income returns as well as the best appreciation potential in various markets. But we're also able to change on a dime. So I'll give you an example of where we did that operationally. So in Atlanta, post-pandemic, there was a huge backlog of evictions. It would take 12 months to get through an eviction proceeding, going through all the proper channels like you had to in the courts in Atlanta. So even though we had a lot of conviction in the market, we thought there's a lot of good employment opportunities, there's good population growth, the operating risk was just too high. So we could take a temporary hiatus on purchasing, which we have over the last year. I think we've acquired opportunistically one home that was just kind of an off-market deal that was like, all right, this is too good to pass up. So we bought that one home in Atlanta, but we haven't really purchased in well over a year there. And once the evictions backlog clears up and there's a better operating environment, we can just go back in. But when you have a staff of 25, 30 people, full-time employees there, that machine just keeps going independent of what's happening for the macro. So I believe that our biggest advantage is really flexibility, both in purchasing and operating. We don't like a particular operating partner, we can call them out like we've been doing with the vacation rental portfolio. And if we like areas, we can keep on investing in them. But we've changed our core investment thesis. Well, no, I wouldn't say we've like full scale changed it, but we've modified it 2-3 times since our operating history, because the interest rate environment has changed so quickly, and the real estate land market or the market has changed so quickly, that we just had to make these modifications. So to the extent that you're a smaller organization that's built more nimbly, those are real advantages in where you're placing your bets and how you can respond to the market, because the market's continuing to change faster than ever. Information travels fast, capital travels fast, so markets are naturally going to change fast too. So I think that's what our advantage is over some of the larger scale operators, where they have the moment in time opportunity to acquire assets, which they've made plenty of money on, and so good for them. But they also have the operating scale that's also a susceptibility.
Fantastic. Cameron, thank you so much for walking through all the details there. I think we cruised through most of the questions that came through. I'll give it a few more seconds here just to give folks a moment. I would say too, obviously, folks have a myriad of different ways to invest, whether it's traditional stocks, bonds, CD, money market funds, so on and so forth, or fractional companies that you're seeing pop up, whether it's residential real estate, art, so on and so forth. So we definitely appreciate all the questions in due diligence, especially when you're parking your funds in well-earned money for an extended period of time. So feel free to join our standard intro to arrived webinar that can come at any time. Moving forward, I also want to mention the single family residential fund. Investments made by April 30th will qualify for the next dividend around June 25th. So that is today. You have till end of day. And then we also have 2 new single family residential properties, individual ones that'll be available on Thursday, May 2nd at 10 a.m. PST. We're very excited for those. Ryan and Cameron, any closing remarks before we shut our virtual doors here?
I'll just start by saying, Korin, thanks for leading us through everything today. And everyone, thank you for joining, for all of the great questions in chat and spending time with us today.
Yeah, echoing all the sentiments. I thought you all had some really great questions. Love to see the engagement and how up to date everybody is on the landscape of what's happening out in the market. So you're always good eyes and ears for us to kind of calibrate against, and which is why we love doing these webinars.
Absolutely. Well, Ryan, Cameron, and Jake, thank you so much for prepared remarks, answering the myriad of questions that came in. For all the folks that have spent an hour and 9 with us, thank you. The engagement is absolutely exceptional. We saw a lot of great feedback and questions today, so we'll be sure to continue to iterate and build for and by each of you. And then wanted to give a kudos also to our Arrive team. You saw everybody in the chat from all different teams who truly are actively listening to everything and all the questions that are coming in. So thank you to our team. Hope you all have a great rest of your day, and we'll be sure to send out the recording via email for you all and also upload to our webinar landing page. All right, loving the love and chat. Hope you have a great rest of your day and happy investing.
All right, thank you all.
Bye all.